Okay, well, since it is the top of the hour, I'm going to go ahead and kind of slowly kind of get rolling here on this. First of all, I want to thank you guys for taking a little time. I mean, I know it's the second to last day of open enrollment, and some of our agents are very busy with that, AEP. It's funny, we were just talking about that. I think half our agents out here with GoldenCare, some are so focused on long-term care, short-term care, that a lot of them don't get involved in Medicare, but boy, I bet you half our agents do. So for those of you that maybe found the time to get on here, I appreciate it. It's not a real long webinar. I think I'm going to probably buzz through this in about a half hour. You can type in questions at the end here. I'll probably bring that up and maybe try to answer some of those. So there's a chat area. I'll bring that up at the end of it. But I guess just a little bit about myself. My name is Jeff Clark. I'm a regional director here with GoldenCare. I've been with GoldenCare for 26 years. I started out in the career shop here selling long-term care. It's all I cut my teeth on. I didn't start selling other products for probably the first 3 years I was here. So I've always been in long-term care. Now my job, being promoted to a regional director some 20 years ago, my job now is to kind of recruit and train agents. But so a typical day for me is breaking down, looking, comparing, contrasting long-term care products, short-term care products, long-term care hybrid products, home health care products, kind of all that thing in the extended care arena. So well-versed, and I've seen a lot of plans come and go. I've personally written about 600 long-term care policies. I don't know, probably 100 short-term care. So that's kind of my background. So I'm going to be going through just the basics of this product. So there isn't really a real in-depth product. Don't worry about writing or taking too many notes. I know that the copy of this presentation will automatically be mailed to you. So let's just go ahead and go through this, because I do want to kind of get to some slides I inserted at the end of this. I haven't seen this presentation before, but it's more or less just kind of some snapshots out of the brochure, so we can kind of get through this. First of all, the OmniFlex product is underwritten by Manhattan Life, a very old company, been around for 170 years, or a Standard Life there. So in Manhattan Life, good company, good partner for this. Right with that. Okay. So if why short-term care, first of all? And you'll probably you'll hear in my voice, I'm pitching more on the merits of short-term care over sometimes long-term care in this day and age. I'm a big believer that the short-term care market is going to replace the long-term care market in many aspects. As you know, there's only 3 companies left we can really broker for long-term care. 10 short years ago, there was more than 80 companies we could sell in long-term care. So the companies, frankly, have just kind of gotten out of the market. And that's because it's pretty hard on the insurance companies. These long-term care claims can be, the unlimited benefits, the, commission, 5% commission or 5% inflation benefit riders on there that made these benefits pay out millions of dollars. They really didn't charge enough premium. So all kinds of problems in the long-term care arena. So a lot of the carriers have kind of gotten out. And to fill that void, we're seeing more and more short-term care plans in there. And I think those are becoming more and more robust. So you're kind of seeing these 2 plans kind of meet in the middle. And I'm going to show you my opinion on that a little bit later in the presentation here. I've got some comparisons between short-term and long-term, and some eye-opening things, I think. For a guy like myself, it's been a pure long-term care guy for 25 years. It's been a real eye-opener for even myself. Even having sold long-term care, this OmniFlex plan that we're about to review is really an amazing product. It's really changing the short-term care industry, and I think we're going to see more, hopefully, more products like this. But for those of you who have boring stats here, but 40% of those people who apply for long-term care between 66 and 69 are declined. Nearly 50% of people that are 70 and over are declined. I've seen stats also, 60, 70% of people age 70 plus are declined. If you do anything in long-term care, it's pretty hard to get 70-year-olds placed. Unfortunately, as we know, people don't start thinking about the long-term care needs till they get to be Medicare age, or 65 or 70 or so. The 55-year-old, when they should buy, it's hard to convince them at that age that have competing expenses, college and other things going on, kids in college, and it's hard for them to commit to that long-term care plan. So it's really, I think, essential for anyone that in the extended care industry. I like using that term because we talk about home care, short-term care, long-term care, depending on what they need. But if you're in that industry, you really have to have something that can get issued. Otherwise, you're just creating the needs for people and spinning your wheels. So with that, OmniFlex, I guess I've kind of already said this, it's kind of transforming this industry. This product, again, is good for ages 45 to 89. And yes, 85-year-olds can get issued. They actually pass underwriting pretty easily. It is a two-tiered underwriting, simplified underwriting that allows a lot more people to get coverage. There's a spousal discount in there, 10%. You do have an inflation rider, and I'll talk about this now and we'll come up later. The inflation in this product inflates both the facility and the home care side. I'll come back to that again, but just want to make sure that I point that out. Aetna doesn't have an inflation rider. Guaranteed Trust Life short-term care has an inflation rider, but it only inflates the facility part, not the home care part. And any of you guys selling long-term care or anyone out there knows that home care is basically the most important part of a long-term care policy, is 80% of claims start at home. So to not inflate the home care is strange, but this inflation inflates both sides, facility and home care. Okay, here's a product availability grid. Not in every state yet. We're pushing. I know Oregon just got on board. Yep, we added it. So that was actually this week. So some of your usual suspects: New York, California, Florida, Jersey. I'm not holding my breath, but we do have another product guaranteed issue in that realm. So if you're in those states and you're looking for someone who can't get underwritten some other way, call GoldenCare. We've got a product for you now. It's a guaranteed issue, long-term care, term life thing. But anyways, okay. The facility benefits. So there's two parts to OmniClear, facility and home care. The facility benefits, $50 to $400. You can buy anywhere in between there. Elimination period, 0, 20, 60, or 90. Benefit periods, 90, 180, 270, or 360. There is a ×2 benefit maximum, so there's a restoration one time in there. And there's a bed reservation benefit. So pretty basic on the policy. Again, up to $400 a day. This is a 1-year plan. Typically, you can get 90, 3 months, 6 months, 9 months, or 1 year. Okay. Now the home care side. Here you can go $50 to $300 a day. Remember, these are indemnity benefits. Okay, it's pretty much all cash. Every day you get care, you get indemnified the full amount. Okay, for that care. So, for example, if you went with $300 a day, and you had care out, you get a nurse out there every other day throughout the month, you would get a check for 300 times $4,500 for that month. All cash, just pay who you want then, right? Unused amounts you keep, etc. Every time you have a visit, you get the full amount. Elimination period on the home care is also 0, 20, 60, or 90. I can tell you when I'm doing short-term care, I use a lot of 20 and 0-day elimination periods. It's not that expensive, as I'm going to show you here a little bit later, as compared to what we're normally quoting with long-term care. Okay, optional benefits. Again, pretty basic overview here, but I want to show you how it compares at the end here. So the hospital indemnity, kind of boring. I mean, you see these riders show up in a lot of plans. I don't think it really does much for the plan itself, but if you're someone who does Medicare work, we know it's Medicare Advantage season right now. If someone does have a Medicare Advantage plan, they've got a big hospital copay hanging over their head. So it's always a good idea to get some kind of hospital indemnity coverage. So there's a nice little rider in this plan while you're talking to them. Again, kind of a throwaway in there. Okay, the inflation protection itself. So it's 5% simple, and it stops after 20 years. So essentially, it's going to grow until it doubles. So if you start at $200 a day, as soon as it grows to $400 a day, it's going to stop. I put a lot of my plans up at $300, $400 a day to start. Use the inflation. Sometimes if I'm quoting someone that's already 70, 75, I just write, $9,000 a month benefit and skip the inflation, right? So it's cheaper. But at 5% it's 5% simple. So essentially in 20 years, it stops growing. So that's how that inflation works. Pretty basic. Some extra little riders are in there. Bed reservation. So if you are in that nursing home and you get hospitalized, have a stroke or what have you, they're going to pay for 10 days. If admitted to the hospital, lifetime maximum on that is 20 days. So they'll hold your room at the nursing home for you if you get hospitalized. Restoration benefits. Now this is a thing that we don't even see in long-term care plans anymore because we kind of knew how rarely it happened. For someone to have to trigger a long-term care policy, they had to have a 90-day period of lack of ADL or deficiency or the cognitive impairment. So this period would have to be 90 days or longer. So once someone pretty much claims on a long-term care plan, they've been sick for a while, they're probably not getting better. We didn't see restoration benefits used very often. So sometimes us long-term care agents don't get excited when we hear the word restoration of benefits. Well, I'm the first to kind of admit that I didn't think it was much either. But then when you think about short-term care, and this is a very unique and very important thing to understand about short-term care. Short-term care doesn't have that 90-day certification requirement that long-term care does. So how often, if you're a long-term care agent, and I get these calls all the time, from my clients who have a long-term care plan, they'll call and say, hey, I got my hip replaced, I got my knee replaced. I'd like to maybe need some help for 6 weeks. I'd like to get some benefits here out of my long-term care. You have to explain to them, like, well, no, see, you're going to be better in 6 or 8 weeks. You've got to have a ADL deficiency that's going to last longer than 90 days for benefits to start working. So, signed off by your doctor. So it's just, it's harder to trigger in that respect. So with short-term care, since there is no 90-day certification, someone can get a hip replacement and they're going to get paid that month for the home care they receive on that hip, on that knee resurgery, when they slip and fall and break their leg or break their hip, when they have a heart attack or maybe a post-surgery where they're going to need help for a month. None of these were ever long-term care claims. Well, short-term care, they all are. They pay immediately, right? So we don't have to worry about if the care is going to be for 90 days or not. You get care, that's it. So start paying me some benefit. So then naturally, if someone does have a hip replacement, uses a couple months worth of benefits, they're going to get better. After 180 days, that pot restores. And it's still a pool of money. So, if you can reuse these things up to one time, the maximum benefit, of course, is going to be a full year payout. So if someone used half a year recovered, they still got a year and a half. It's still a total out there. So I kind of show you some of that later, but the restoration of benefit, I don't want it to be overlooked in short-term care. Not much of a benefit anymore in long-term care, but in the short-term care, it will come into play. All right. Prescription drug benefit. Oh, this is kind of taken, borrowed, if you will, from most of the home care only plans out there. So, if both of them work, they're going to reimburse you $10 for generic or $25 for a brand name. And so that's up to, policy maximum of $300 a year. But, most folks that are applying for OmniFlex maybe has some health concerns to begin with, or they're typically not people that are, no meds, no prescriptions, perfect height and build and what, so those people probably qualify for long-term care. So a majority of who we're applying for OmniFlex have prescription drug use. So it's very easy just to go ahead and back $300 off their annual premium. So and we have a prescription drug reimbursement form we can give you. So you send your client when they get their policy. You can claim it all at once. You can wait till like 6 months to build it up and then claim the $300, or you can do it each month. So pretty simple benefit. Fast 50. So this is in the home care area. So I mentioned you can get up to $300 per day for your home care. So that's $9,000 a month. That's, again, every time you have a nurse come out there, a professional, an LPN, an LVN, a maid service, what have you. Okay, well, the Fast 50 says, look, if husband and wife are taking care of each other, this person's qualified for benefits. They've got a 2 out of 6 ADL deficiency, or they're cognitively impaired. But mom doesn't really want a stranger coming out there. I mean, she's helping him get up in the morning. She's helping him slip into a shirt, and she's bringing him to the kitchen. She can make him some eggs. She could have a stranger come out and help him get dressed and make him some eggs, but she doesn't want a stranger in her kitchen. She's going to do this anyways. So there's an option here to say, instead of being reimbursed up to $9,000 a month, we'll just give you $4,500 cash each month. Mom can take care of dad, no questions asked. Now, you are giving up half your benefit for that. But again, I have enough claims. All I hear from my customers is, can my daughter take care of me? My neighbor kid's mowing my lawn, shoveling my snow. The churches bring me meals. My spouse really does most of it. My daughter comes by and helps out. Well, you can't pay these people with long-term care unless you're using the cash benefit or something. But essentially, you can't get access to that. So many people are using and relying on the spouse anyways, even when they have a policy. So this more or less just says, hey, we'll give you half the money if your family member is taking care of you. You can just take the option of Fast 50, no questions asked, get $4,500 a month for up to a year. Okay, so that's just an option people have. Why Fast 50? I guess I've kind of already explained this a lot, but I see it bear out my own stuff. I mean, invariably, all I hear from people is I want to pay my daughter, my kid, my spouse, my neighbor kids. So from 2015 to 2020, the number of unpaid family givers is gone over 53 million now. Essentially, 1 out of every 3 people who work in this country are also taking care of a aged parent or loved one. We know the whole caregiving story. It's really overwhelming. It's only going to get worse. We're simply running out of able-bodied caregivers here. A lot of this falls back on the family. That's only going to continue as we run out of nurses and the population doubles again, the senior population. So the ability to pay family members, and look at this, 53% of the people were home, loved ones were home health aides. That's most of the care. It's very basic in nature. But here, 28% of the time, it's family, friends, or independent paid. So, almost 30% of all claims are family members as it is. And those aren't typically getting paid by most of your traditional long-term care plans. So it's nice to have that cash. It's nice to have that option. Okay. Can you go through a couple claims examples? I really kind of don't love reading to people in a presentation, so I apologize. Kind of feel like this is just cut right out of the brochure. You can probably kind of read this on your own, but I'll kind of buzz through these. So this guy has 40, okay. He wanted to age in place, which I think all of us do at this point, okay. He got a $280 base daily benefit, 360-day benefit, 5% inflation. So 10 years before his health changed and the system was deleted. So with the inflation growth, his benefit's now going to $350. He goes on claim. His spouse provided that informal care at home, $175 per day with the Fast 50. So again, typical, that's going to happen. After 6 months of receiving this care, his policy had paid a total of $31,500 out in Fast 50. Then it looks like he recovers. His benefits will then restore to full again for the next time he needs care. Boy, I got some better claim examples. You know what? These are boring me even. Sorry. Okay. Eligibility questions. So, this policy is actually really easy to get. Unlike long-term care, it's kind of two-tiered underwriting system. So this is the question. This is it. So if you can see here, have you been treated or diagnosed medically professional of having acquired AIDS? Are you currently disabled? Okay. Are you currently receiving assistance, supervision, perform activities of daily living? Are you currently receiving home health care services? Being treated for dementia? Being treated for diabetic complications resulting in neuropathy, retinopathy, kidney disease, failure, renal insufficiency, or kidney dialysis? Or receiving treatment by a medical professional for insulin-dependent diabetes in conjunction with heart failure. So essentially, they got to be in pretty bad shape. They can say, no to all those, and there's no pending surgeries, they're going to get issued a plan. So the last question here too is, leukemia and cancer. Within the past 24 months, you've been diagnosed or received treatment for or been prescribed medication for any of the following conditions by a medical professional: cancer, other than skin, leukemia, lymphoma, malignant melanoma, cancer, melanoma, that is spread to the original site. So that's it. If they can answer no to all those things, this policy is issued in 7 to 10 days. Okay. Limited benefits. So if they answer yes to this one, they're going to be reduced down to $100 maximum per day. So they get a $3,000 a month benefit. Okay. So if you've had a stroke in the last 24 months, a TIA, again, normally with that 24 months, that's a decline for long-term care, right? Someone's had a TIA in the last 24 months. If they're on diabetic and they're requiring more than 50 units, that's a knockout for long-term care. Not for this plan. They can get a 1-year benefit, $3,000 a month. Systematic lupus, multiple sclerosis, cerebral palsy, Lou Gehrig's disease, psychotic disorders, alcohol, substance abuse, any of that stuff in the last 24 months, they can still get the 1-year benefit. Amputations caused by disease, chronic obstruction lung, pulmonary disease, chronic bronchitis, emphysema, respiratory. You see all these things that we can now insure without limited benefit. So again, we're catching a lot more people with this thing because again, it's a 1-year payout. The insurance company's not in that much trouble, right? They don't have to worry about paying out these huge 3, 4, 5, 6-year benefits. So people often ask, is the insurance company itself going to be protected here? Yeah, because they're doing a very limited benefit for this. Okay, this is kind of going to explain the benefits overall. So if you look here again, you have a choice between a 0, 20, 60, or 90 elimination period. You can have up to $400 per day, which is $12,000 a month, right? So you can put inflation with that. In the home care, you can have up to $300 per day or $9,000 a month. Okay. So if you add that, if you max out both things, $400 a day or $12,000 a month for the facility side, $9,000 a month. These are separate pools, by the way. Okay. So $12,000 for a month is $144,000. And then the $9,000 a month is $108,000. So you basically get $252,000 of total benefits if you max this thing out. That's a pretty robust pool of money. You try quoting long-term care for $252,000, $250,000, those premiums are north of $4,000, right? So this is, again, is an all cash benefit without a 90-day certification period that pays directly the insured up to $250,000. And by the way, you can reuse each one of these pools once. So really there's a total of $504,000. I'm not going to say the restoration is going to restore and you're going to use all $504,000, but it's very possible, like I mentioned earlier, that you might have some reclaims on some of these things. Again, the short-term ones, the heart attacks, the broken hips, broken knee replacements. So pretty robust benefit, really. It's a pretty nice, and again, if you did the simple inflation there, that 504 grows to $1 million. So, and I'm guilty of this as well. I used to think short-term care, small little benefits, I need something that's going to pay these people for a couple of years, right? Well, this is $1 million of coverage. Granted, let's just call it 504,000 if it doubles. But even if you don't use restoration benefit, it's still $500,000 of coverage with growth. So, it's actually more robust than you might think. And I do have, let's see how far close we're getting that. Okay, let me go through this part here. This is important. So you're wondering, back to the underwriting here, how can we issue these kind of things? How can they go ahead and do the underwriting like this, even if it's a 1-year plan? Isn't that kind of hard on the insurance company? Well, how they protect themselves from this is what I like to call a graded benefit. It's a ramp up. So they protect themselves from, someone goes on claim a year later. So when you buy this, $200 a day or $6,000 a month benefit, okay? After 1 year, you have 60% of that available to you, okay? So again, let me start over. You start with $400 a day. You buy a $400 a day benefit, okay? From day one, you have access to 50% of that. After 1 year, you have access to 60%. After 3 years, 70, 80, 90. So after 5 years on the first day, you've got 100%. What that does is that only having to pay out half the benefit if they claim like in the first couple months, or again, maybe only if they claim the first 2 years, they only have to pay out 70% of the benefit. Just like a graded life insurance, that protects the insurance company severely. That's why they're able to offer so many people coverage that normally wouldn't get coverage. So remember, we're not talking about taking, married 54-year-old couple that have plenty of money, they can afford $3 or $4,000 each for a long-term care policy. We're not looking at short-term care. But and I did a webinar on this a while back. I pulled the numbers, out of I think it was close to $5 million of long-term care premium we wrote with Mutual Omaha. Me and us in our sister office, so AIM, Yakima. So between the two of us, we'd written about $5 million. Between those two numbers, our average long-term care pot of money was $146,000. We're writing a ton of $100,000 benefits in long-term care now. Granted, some people are writing $200,000, $300,000. Occasionally, you see a $500,000 pot, but especially for our over age 65 people, most of what we're writing is $150,000 pots of money. So in that short term, you don't see people go and claim that quickly often. If they do, great. The insurance companies are prepared for that. They've charged more premium. They've underwritten more. So they can allow to kind of offer this robust benefit by just simply grading it. By simply saying, it's going to be a little bit of a ramp up here. So if you claim a year 1 or 2, and who's going to be mad at you if they write you a couple premium checks and they're still going to get, $6,000 a month benefit and they go and claim 6 months later, okay? So this is the way that it protects the insurance company. It offers the clients a great benefit. And overall, it presents itself to be a very strong policy. So ideally, we don't think people are going to go and claim a month after we write them. Okay. So, no, this is the RX form I talked about earlier. And I have this form for you if you need it. You simply just fill this out and send it in to them. You can also do it through your online mobile account. I know Manhattan has an app. I put this on my phone. You scan the barcode over, and you can upload documents to them. So if it's on your cell phone, you can simply upload it right to Manhattan site, and they'll reimburse you for those prescription drugs. So they couldn't make that part easier. It literally is $300 off your policy. Okay, let me show you something else. Not there. All right, I gotta scramble here. Bear with me. Where did I put that now? I wanted to show you something else that I actually put together. I thought that was going to be added at the end of this presentation, so just bear with me for 1 second. Where did I put that? Okay. So, again, going through the brochures, and again, I hope I didn't bore you too much, but I'm hoping you guys are seeing this. So how does it shake? How does it compare to long-term care? Because that's really at the end of the day. I can go through these brochures and tell you that short-term care is a great option, et cetera, et cetera, et cetera. But look at it side by side. I was telling you the story earlier about the fact that most of what we're selling in long-term care now are pots of money of around $150,000. Again, our average is like $164,000 for the year, 146, I forget, one of those two, right around 150,000. That's a bulk of what we're selling in long-term care. In other words, when I'm quoting a 60-year-old couple, I want to sell them, at least a $4,000, $5,000 a month benefit, and I want to give them a 2 or 3 year plan, right? Well, that ends up being a pot of money of about $140,000. Well, that's expensive now. I don't know if you guys have quoted much of it lately, but for a 60-year-old couple, it gets to be expensive. So, and honestly, after looking at the short-term care, after looking at this OmniFlex product for the last year, we released it in January. The full release was in June, but I'm not sure anymore that long-term care is the way to go for most of the people that we're selling. Let me show you what I'm talking about. So this is just an example I put together. This is the OmniFlex versus traditional long-term care. And again, I'm not trying to bash traditional long-term care. I cut my teeth on it. I've been in long-term care forever. It's always going to be available. It's always going to be something that's an option. I call it this extended care industry where we have home care, short-term care, long-term care, hybrid. There's just a lot of ways to go about it. But again, I'm not convinced that short-term care is the best way if you're talking about selling smaller amounts and small pools of money, which most of us are doing anyways. So just bear with me on this. I'm going to do a $12,000 a month benefit. Okay, so I'm going to max out this OmniFlex thing, $400 a day, $12,000 a month. And I'm also going to max out the home care, $9,000 a month, right? So $12,000 a month for 1 year is the same as a long-term care selling $4,000 a month for 3 years. Both of them end up paying out $144,000. Difference in long-term care, of course, they're going to bleed that over a 3-year period. If you die a year and a half into it, well, you didn't get your whole payout, right? Okay, so $144,000 each. Each we're going to pay out $144,000. Wouldn't you rather get your money all back in 1 year? Because remember, unused amounts just stay with you. So ideally, you get all that money, these premiums you paid in. Wouldn't you want to extract your benefit as quickly as you can? In other words, get your money back out of this policy. You'd want the ability to get those premium dollars back as quickly as possible. If I'm pitching the value of this insurance, it's more valuable to get it back quicker, right? Okay, that's common sense. So take a look at this, $144,000 each, both 90-day elimination period. And I did the 0 day on the home care for the OmniFlex. I did the home health care waiver on the traditional long-term care, okay? I didn't put inflation here just to keep it easy for this one. Look at the premiums. $1,410 versus $1,906. And by the way, that prescription drug reimbursement that's so easy to qualify for, it's $1,100 versus $1,900. And by the way, they're both $144,000, like I told you, but they're not. I've also got an extra pot of money of $108,000 for home care, all cash, no 90-day cert, easier to claim, all cash. It's not half, but it's about 60% of the premium. 1,100 versus 1,900. So again, 12,000 over 12 months or 4,000 over 36 months, they both pay 144. Except for short-term care, you don't have to pay nearly as much in premium, right? Now look at it come, let's see, do I have come claim time? Well, I put the inflation there. Okay, same thing here. I just ran it with inflation. Okay, and 5% simple, if you know long-term care, is pretty close to 3% compound. All right. So here again, 9,500 versus 5,500. And remember, oh, in this example, we ramped up to 6,000 a month for 3.5 years, because now I've actually got a pot of money of 252,000. You know, with the, if you add the 144 and the 108. So try to, again, equal out the benefit, the pot of money, 252, look at the difference in premium. But the big difference comes come claim time. Okay. So when you go on claim, would you rather receive 144,000 over the course of 1 year or 48,000 over 3 years? I think I kind of explained this, that, yeah, it's more advantageous to get all your money up front. Nobody wins the lottery. And if you could get all your money first year or over the course of, or have to be bled over a course of, 20, everyone would take the cash option if there wasn't a cash, in this situation, you don't have to give up some of your benefit to take it all up front. So we're just giving you your benefit back a lot quicker and not have to be bled over 3 years. So the example I think I use in here is, so here's a person has a stroke. They have a 15-month facility. They spent 15 months in the nursing home. Okay. And by the way, 90% of claims don't exceed 2 years in the whole long-term care industry, 87 or 80. So, 9 times out of 10, you're not looking at benefits that go much beyond 2 years anyways. And short-term care, remember, if you're getting care a couple times a week in the home care, that might last you for 2 years. There are pots of money, so it's not necessarily going to be only 12 months. But okay, so in this 15-month example, okay, again, in the 15-month, they go to a nursing home. Okay, so after 15 months of being there, 90-day elimination period, the OmniFlex would have paid out $144,000. Okay. Long-term care over that same 15-month period would have paid out a total of $48,000. So again, if you go to a facility for 15 months, OmniFlex would have paid you 3 times as much. Okay, that's pretty easy to see, right? Here's another example. Here's a 6-month home health care claim. It's she had a hip fracture, right? So she's at home getting some care for a while. So with the fast cash in that 6-month period, again, getting the $4,500 for 6 months, that's a $27,000 payout over a 6-month period. Now, traditional long-term care, Mutual Omaha has a 25% cash benefit built in there. So they would have received 25% of their benefit. If they took the cash option, they would have gotten $6,000. So again, that fast cash to be able to pay family members, long-term care can address the ability to pay family members. They'll give you 25% of your benefit in cash. So over that 6-month period, traditional long-term care would have paid her out $6,000. OmniFlex would have paid out $27,000. Okay, they both utilize the first day cash benefit to pay the informal care for them. So again, 1,100 versus 1,900. It's hard for me to argue. If you're selling pots of money of $150,000 or less, it's really hard for me to say that long-term care is a better option. As a matter of fact, I don't care. I'll say it. It's not. And it took me a while to get there. Look at, again, I told you earlier, my job is to compare and contrast these plans. Well, I've been doing it for the last 9 months, 11 months. Got to tell you, if it's me or anyone in my family, or I'm not selling them a $150,000 long-term care plan anymore. I'm selling them a short-term care plan. Easier to access. It's all cash, higher amounts for less premium, right? It's hard to make a good argument for long-term care unless someone, again, has plenty of money. They're in their 50s, they're healthy, and they want a $300,000 pot of money each shared. So they don't mind spending $8,000, $9,000, $10,000 in premium. Plenty of clients like that. A third of the clients, a quarter of our clients are still buying that kind of stuff. But a majority of our clients, at least 2/3 of them, are buying pots of money of $150 or less. And I think for all those people, they've been better served in a short-term care plan. All right, boy, I'm on my soapbox here. Same thing here. This is a 6-month home health care claim with the RN visiting 3 times a week. Okay, so every time that nurse comes to the door, remember, You get paid $150 a visit. So it paid you out $21,600 over a 6-month period. Again, having a nurse out there every other day. Traditional long-term care would have paid you about $10,800 or less. I could do all kinds of these claim examples. Come claim time, short-term care is a much better deal. Okay. All right. Last slide here. Why short-term care? And I've already kind of talked about this, so I guess I'll just kind of close with this. You know, short-term care is going to save this industry. Long-term care carriers are getting burned. They more or less are kind of getting out of the industry because these mega claims. They stopped doing unlimited policies. They do $500,000. So the carriers like short-term care are only cutting themselves the liability of a 1-year benefit, right? So by doing that, it takes the overall exposure to that insurance company way down. Okay. The inflation. So they cut it at 20 years. So it can't, someone buys a policy at 55 with 5% compound and they live to be 95. That $6,000 a month benefit they started with is now paying $19,000 a month, right? Those are huge claims, $1 million claims. I think I read somewhere the largest long-term care claim now is over $2.5 million. So, and there's a lot of those long-term care policies out there that these long-term care companies are getting crushed. So since it's limited, there's no real catastrophic claims for the short-term care companies to worry about. It protects them. Because of that also smaller liability, they can throw the underwriting net wider. They can catch a lot more people because they're not getting exposed themselves. 90% of claims don't exceed 2 years. So will this cover someone that gets Alzheimer's and ends up in a nursing home for 11 years? No, probably wouldn't. But those are less than 1% of claims. So I would love to be able to write every one of my clients a $500,000 pot of money with 5% compound. But most of my clients don't have 20 grand in premium to give me every year, right? So if you want something affordable, something that will pay out, something that's flexible, affordable, and the other thing too, there's no certifications needed. There's no partnership certification needed to sell this. More and more and more, I really do feel like the short-term care is going to start replacing that long-term care. And I was kind of bummed that the long-term care was going to dry up and go away. It's not going anywhere. I'll tell you why it's not going anywhere. Because the extended care need is not going anywhere. We got a tidal wave of people coming that are going to need help. And as I started this webinar with, most of these people can't get coverage. They can't qualify for long-term care or can't afford it. So if you can't get them underwritten and they can't afford it, then we got to find a different solution. I think short-term care is going to fit that bill. So anyway, short-term care allows us to go back to the future and start helping a lot of these older people. When I started selling long-term care, 71-year-old was the average person buying it. Now we're down to like 57 or something, like that 56. So, but 71-year-olds, I was getting 80% of my people issued, And it turns out that it hurt the insurance companies a little bit. But so anyways, we have a viable option now, very robust benefits. So the biggest thing today is let's not think about it as being a less of a benefit. Short-term care is a very viable option, and this Manhattan Life OmniFlex is the strongest of those products out there now. More and more of them will be coming, I'm sure of it. So I want to thank you for coming on board today. I know it's 2:39 here, so I'm going to hop off. Let me look for questions here. I haven't bored me to death here. Okay, we still have some people on there. That's a good question I got on the cash. Couple of them here actually. So one of them is with the Fast 50, and that is, and I kind of agree with you, Craig. If you get someone to come out there and do the care for you, yeah, if it's someone who lives with you, your spouse, she's not a licensed home care worker, so therefore she couldn't get the whole amount. But why wouldn't you just maybe have a home health aide come out anyways, do your dishes and get paid the full amount, right, for that day? You collect the whole amount. So I kind of know what you're saying, Craig. So yes, I think the Fast 50 is when literally mom doesn't want a stranger in the house at all. She's doing most of the care anyways, and she can get by doing it all herself. Otherwise, you'd say, listen, I'm going to have a nurse come out here a couple times a week, and that way I get my full amount, and it'll last me for 2 years then. So having the full amount every other day. So yeah, the Fast 50 is a nice option for someone that's purely going to be a family member. It's not a licensed home care agency or anything like that. And the other one I have here is, have we filed any claims? Yes, we've had our first claim with Manhattan Life, and apparently it went very smooth. So we launched this thing in June. We've already had a claim. And these things are considered guaranteed renewable as long as you pay your premium. As far as rate increases, I don't see the need for the short-term care to file a rate increase. Again, it's a limited 1-year benefit. None of the home care, short-term care plans have been anywhere close to a rate increase. The liability just simply isn't there. It's a catastrophic claims, and it's the long-term nature of these long-term care policies that got the companies in trouble. The long-term care companies, again, they were banking on 30 years worth of investments. The long-term interest rates went in the tank in this country. And so now the short-term care plans have learned from a lot of those mistakes. They've cut off most of their liability. So I don't anticipate, I can't imagine a short-term care plan having to take a rate increase. I'm pretty confident in that. Having been in this industry and look at it from 10,000 view daily, I don't see the short-term care industry having that problem. Okay, so that's all I got for questions. I'm going to hop off here. I want to thank you guys for coming on board. They are going to be sent a copy of this presentation, which again, I apologize, it's kind of just more or less a version of the brochure, but I'll try to maybe get you, if you want to copy some of those comparisons I have, we have some of that stuff on our website as well. So just give us a call if you want to talk more about this product or get more information, talk about a case. We're here to help you. I wonder if I have my 800 number somewhere on one of these slides. I don't. Our phone number here is 800-842-7799. But I want to thank you guys for coming on board today. And if we can help you get selling this product or any of our products, please let us help you. Again, 800-842-7799. There are pre-recorded versions of this presentation and other ones by different speakers. You can go to GoldenCareAgent.com, and there's a whole arsenal of tools, pre-recorded webinars, or other selling tools for us, information on OmniFlex, etc. Otherwise, give us a call, 800-842-7799. Good luck selling, happy holidays and all that stuff, and hopefully we'll talk to you soon. Thanks, everyone.
GoldenCare is always here to serve you with new tools, new products, new ideas, and new innovations, and always the best support in the business to help you succeed. So give us a call at 800-842-7799 and check out our website at www.goldencareagent.com.